Hey, it's about that time. Welcome to the show. This is the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. Today is Thursday, the 8th of December. I'm your host, JD Durkin. Opening bell rung just moments ago here on the floor by AMN Healthcare. Taking a look at how our major averages are kicking off this Thursday. Stocks are mixed. What are we looking at? No, we're up fractionally on this morning after yet another down day in the market yesterday. That's been the tale of things for quite some time, 5 sessions in a row, as a matter of fact. This as investors continue to assess the risk of a recession ahead of the Fed's December meeting next week. Let's take a look for what is on tap for this morning's show. Recession, of course, top of mind this morning as big bank CEOs double down on the likelihood of an economic downturn. Plus, we'll talk Elon Musk as bankers ask the billionaire to use Tesla stock to back his Twitter loan. Yeah, that's right. And finally, we'll dig into GameStop's earnings reports as that company reports its 7th straight quarterly loss. For more on those stories and so much more on this Friday Eve, we now welcome in our senior editor, our chief markets correspondent, Mr. Martin Baccardax. Martin, good morning to you here, my friend. We are coming off of a 5-day rout. What is top of mind for you and you think investors in the major market indexes on this Thursday morning?
Well, we're looking at, apart from the modest gain that we're seeing in the opening minutes of trading today, JD, we're looking at the worst start to any month since 2011. This is a 5-day losing streak that's really snuffed out most of the gains that the market has experienced since we had that softer CPI print in the early part of November and a reasonably dovish tilt from Fed Chair Jerome Powell in the latter part of the month. So a great deal of that is being tested right now by the thesis that the Fed is going to have a more difficult time engineering that soft landing. To put it more specifically, are the rate hikes that the Fed has planned and has doubled down upon going to tip the economy into recession? If you were to look at the economy today, that would be a hard argument to make. But looking at forward indicators and putting together the sort of mosaic of data that typically foretells recession, that's apparently where traders are headed right now, being played out in the bond market and really up until this morning being played out in stocks as well.
10 points for use of the word mosaic. I do believe this is the second show in a row where you have appropriately used such a phrase. And it's just, honestly, Martin, it's just not a word I get to use day to day. So whenever I get to say mosaic or tapestry to describe economic conditions, I'm a big fan. I do want to ask you about the U.S. Treasury yield climbing again here this morning. What does that tell you?
There's a lot of volatility in Treasury yields, JD, and I wouldn't necessarily want to put too much on today's movement simply because they aren't really in keeping with what we're seeing in the broader market. What has been more in focus, I think, is the fact that the yield gap between benchmark 2-year Treasury note yields and 10-year note yields is holding at around 84 basis points. That's the steepest inversion of the yield curve since the early 1980s. We are seeing the steepest curve from 1-month Treasury bills, 3-month Treasury bills to 10-year note yields since December of 2000. And 1-month bills are trading at a higher yield than 30-year bonds. That simply should not be happening. And as a result, the bond market is flashing those recession signals. We're seeing a bump up in yields this morning. There was a bit of noise around the jobs data, but I wouldn't have necessarily thought that would indicate selling off in the Treasury market. So my suspicion is that we are just seeing that elevated volatility, which is part and parcel of the Fed's plan to roll off debt from its balance sheet. The Fed's balance sheet now stands at about 8.6 trillion US dollars, and they're selling about 120 billion into the market each and every month. So there's going to be dislocation as a result of that. And then, of course, there's going to be corresponding volatility at the same time. I would put today's moves more down to that than anything more broadly macroeconomic.
Of course, we've been talking about how influential CEOs are weighing in about a potential slowdown or a slowdown they're already seeing. We heard from Wells Fargo CEO Charlie Scharf at a financial conference this week. Here's what Mr. Scharf had to say. There is a slowdown happening. There's no question about it. He says we are expecting a fairly weak economy throughout the entire year. There's a unique position, Martin, that bank CEOs have with regards to the parts of the economy that they pretty uniquely have insight into that maybe other CEOs don't, given the flow of money in their accounts, and they see how people are spending their money, where they're spending their money. What insight into the overall economy do bank CEOs like Charlie Scharf have, and why is it really important to pay attention?
Well, I do think it's important, but it is part of a significant debate as to whether what the bank CEOs are seeing is being reflected in the broader economy. I think for the most part, bank CEOs are able to see two portions of their businesses that are instructive as to how the health of the economy is developing, and that's in the mortgage market and in business loans. It's very difficult for small businesses, which comprise the largest part of commercial activity in this country, to expand without credit extension. As credit gets more expensive and banks get more conservative, that becomes more difficult. And as a result, business investment tends to shrink, and that's a significant factor in any economic slowdown. The mortgage market as well is significant with respect to the power that housing has in the broader dynamic of economic growth, particularly here in the United States, because so many people tend to refinance, and refinancing are falling down quickly as a result of the jump in the Fed funds rate, in Treasury bond yields, and in the broader interest rate complex. So to some degree, that is what they are seeing. That isn't necessarily part of the view of the men and women that lead companies outside of the financial sector. So therefore, it is very important. But when he says there is no doubt that the economy is slowing, I think a lot of people would sort of push back and simply say that the labor market continues to expand, wages are rising, retail sales have been accelerating, although not at the pace that they had been previously throughout the autumn months. And the Atlanta Fed's GDP Now forecasting tool says we're growing at a 3.4% clip. Now, I don't doubt that that growth mechanic is going to be tested, but I don't know that it's quite fair to say that we are slowing without a doubt. I honestly do think there is some doubt, and that's a large part of the reason why we're seeing these differing economic and financial results being played out in stocks and bonds and currencies and everything else.
I don't know that we talked too much about that 3.4% figure, pardon me, from the Atlanta Fed with regards to GDP now, but we did get that indication, I believe it was on Tuesday of this week. And I don't know that it's something you and I talked about too greatly in detail. Can we go there for a bit, just for a bit of context and perspective, Martin, about why that number matters so much? And for people who are kind of wondering about the regional responsibilities of the Fed, someone may be asking, well, what is it that's unique to the Atlanta Fed specifically as to why this data point is so important?
It's not necessarily unique to the Atlanta Fed as such, because it takes in information from all around the country. But what it does do is provide a real-time look at economic growth prospects, whereas typically when we look at GDP data, we're looking in the rearview mirror. The numbers that we'll get for the fourth quarter, of course, won't come until the last part of January, and they won't be finalized until the early part of February. And by that time, many things may have changed. So it's a useful tool in the sense that it does tell you, at least as best we can in real time, what growth metrics and how growth metrics are performing. But it has to be remembered that because it's a real-time indicator, if there are pieces of data that come in after the snapshot, they could have a significant impact on the reading. So the 3.4% may not hold throughout the entire quarter. We may get numbers that will drag it down significantly as we get closer to the end of the year. But it is an interesting mechanic in the sense that it can give us that indication of real-time growth, and it's better in some respects than the rearview mirror figures that we typically rely upon.
So to compare it to the world of politics, it's sort of like polling, right? Because we always say in the world of politics, polling is simply a snapshot. Things can happen after that, jolt an election one way or another. Don't put too much stock into polls, you see, because it is exactly that, a snapshot. And I kind of like that, that's the word that you use to describe this key point of economic data, keeping in mind that things, of course, can come up after that change the integrity, if you will, of that original snapshot. I do want to ask you about the Department of Labor today. Of course, a key reading that we are following. People who are filing claims, people who are filing claims for unemployment benefits for the very first time rose to 230,000. That's right in line with expectations. How important is this for the Fed's meeting next week, Martin?
Probably not a game changer, but sort of indicative of that just quiet creeping weakness that we're seeing in the job market, which again, grimly is probably what the Fed and other economists are hoping for, because eventually there will need to be a slowdown in order to sort of tame some of the broader inflationary impacts of wage increases. Again, this is counterintuitive, at least from a human point of view, but this is the world that we live in terms of economics. I think the number that was maybe a little bit more arresting today, JD, was the continuing claims figure. They're published on a 1-week lag, but nonetheless, There's about 1.67 million people now who are filing continued week-by-week claims for unemployment benefits, and that's the highest since February. That may begin to have a closer reflection as to what we are seeing in the job cut headlines that we've talked about for much of the week. Challenger Jobs Report is something that we can all look at, which tends to try and put together a collective of layoff announcements. I think that number is about 326,000 so far this year. I think, if I'm not wrong, it's up about 7 or 8% from last year, but that number is accelerating into the end of the year. So the continuing claims number, whilst tending to be a bit of a lag, is now becoming a little more important because it might reflect the job cuts that we've witnessed over the past few months. So I'm going to look to that one for the next few weeks to see in what direction it's headed. And ultimately, it will need to grow larger in order for there to be some anticipation of slower wage growth. And that, as a result, will lead to a slower series of inflation prints going forward.
With regards to anticipation, of course, people who are watching this right now are likely well familiar with this huge series of headlines, Martin, that we've had over the course of the last few weeks or so with big tech layoffs. You know, I would think that if you are an employee at an Amazon, maybe a Twitter, a DoorDash, some of these high-profile companies that have laid people off, you probably also get, oftentimes, not always, but severance packages. They may extend 6 weeks or 9 additional weeks. Is there something to be said to say that these weekly jobless initial claims may not quite yet reflect all of the layoffs we've had yet, presuming that a lot of people may accept those severance packages, and if they claim, they put in for unemployment claims, it would only be on the back end of that severance window, so as if to say, maybe we haven't quite yet realized the numbers. These numbers could go much higher in time as these layoffs have a lingering effect. Is that a fair reading of some of the potential timeline here?
You're absolutely right. And this, JD, is precisely the reason why economists say that unemployment figures are a lagging indicator, because by the time that we understand their implications, we've already gone past what they're telling us. So to some respects, they aren't able to sort of guide us going forward, but they are a very good indicator of what has happened in the past. Now, the one portion of that I always find a little bit difficult to sort of come to terms with in real life is the fact that people's expectations for their employment security has a significant impact on how they spend. So whilst the jobs data won't necessarily capture, as you rightly described, what is happening with respect to layoffs because of severance packages and maybe just people's inability or unwillingness to go right back into the job market, they may want to stay out for a few months for a number of reasons. We can't get the reading that we would like, but we can translate to a certain degree that number and what it will mean for consumer spending, because again, those two are much more tightly linked. The idea of job security and your ability to spend, or your willingness to extend your personal credit as a result. And I think those numbers tend to be, at least from my perspective, a bit more useful in a real-time scenario.
And how much further complicated can this get, considering holidays can be a volatile season for layoffs? Businesses can adjust these numbers week to week, right? So, I mean, you got this part of the season. I imagine you got a lot of companies out there who think they may need to lay people off, and then kind of pull an Elon Musk and say, oops, actually, we could actually probably use you back on the payroll for a bit longer. So, oftentimes you do take this with a grain of sand, don't you?
For sure. And this is an unusually complicated time for the U.S. job market as well, because, of course, we have about 1.7 people available for every one job that's out there. So I beg your pardon, it's the other way around. There's 1.7 jobs for every one person. There's 10.3 million people who remain on the job sidelines, in the sense that there are those many positions which go unfilled. So the COVID pandemic has changed the nature of work here in the United States, and indeed in most countries around the world. And that has made it even more difficult to sort of understand the movements in the jobs data and what it means for broader economic.
Yeah, I remember the story in Forbes from just a couple of weeks ago. It openly asked, where are the workers? Right? Because at the time, I think it was 1.9. Back then, it was 1.9. Now you're saying 1.7. But still, it's nearly 2 jobs unfilled for every 1 job seeker. And people are looking around saying, where are the workers? Where do people go? Obviously, people's habits and personal decisions have changed, and quality of life considerations are different now post-COVID. I'm sure you've had people who said, are you kidding? The thought of going back to a 9-to-5 or going back to a job? Not for me, not in the cards. But we'll see how the dust settles. It's a fascinating conversation.
It really
yeah,
is,
go ahead, Martin.
Because here here I am in Southwest Florida, which has been ravaged, of course, by Hurricane Ian, and all I see around me is commerce related to the rebuilding of the area. And there's all sorts of jobs being going on. I can tell you that the traffic is intense in this part of the state as a result of vans and trucks and lorries and everything else like that, carting equipment around to either clean out debris, build new houses, repair houses, and all those other things. That employs scores and scores and many hundreds of people as a result, thousands for that matter, not all of whom are going to be on official payrolls. So whilst they were still generating income, they aren't a part of the additions that we count when we talk about jobs. And you can repeat those circumstances all over the country. And that's why, to some degree, when we talk about where have the workers gone, maybe they are there, they're just flying under the radar.
It's awesome perspective. And the best type of journalism is the type that you personally observe, which is what I appreciate about what you bring to the table, Martin, because it's not just the numbers, it's not just the big stuff that you're very good at tracking. You know to quite literally look out your window and figure out what that means in terms of the community. We say all politics is local, certainly applies to the economy as well.
Absolutely.
About once a week or so, Martin, I'd like to ask you about the CME Fed Watch. It's about that time of the week where I'm going to ask you again, given all the recent economic data, for people who don't follow it as closely as you do, what are the current expectations? Are we looking at 50 for next week?
Well, absolutely. That is where the balance of money is being bet. In interest rate trading, for example, it's pretty much a lock. I think it's somewhere around 90% is the expectation of a 50 basis point rate hike next week. The Fed funds, the Fed Watch tool is only pegging that probability at around 75%. And I have to say, I was a little bit surprised when I looked at the number this morning because we are seeing very small but creeping bets on another 75 basis point rate increase. Now, clearly, that's very, very unlikely to happen. But the fact that traders can see value in potentially anticipating it, or at least trading around it, is very, very telling, because ultimately it says that the inflation concern is still foremost in a lot of investors' minds, even if we are facing down the chances of a near-term recession. And that, of course, is the situation that you would like to see least, where inflation stays elevated and the economy turns lower. That, of course, creates the dynamic of stagflation, which is incredibly damaging and has really only happened on a couple of different occasions. But at present, I still would put the smart money on that 50 basis point rate hike, similar increases heading into the spring, and then the Fed arriving at that terminal destination of a range of between 5 and 5.25% and holding it there for a number of months.
Anything else here? I do want to pivot the conversation here and talk Tesla, because I know that's top of mind for you. Martin, you were up. I saw you file a story in the 5 o'clock hour. I still don't know how you do it, but specifically on Tesla. But before we do, anything else here on the Fed as a little bit of a preview for next week that you'd want to drive home before we switch gears? That's a Tesla pun.
Well, the one little factoid I thought that was interesting, JD, that I only found out late this morning was we are now looking at the first year-on-year decline in U.S. gas prices. And I was really sort of surprised to see that.
Yeah.
333 is the national average, according to the AAA, and that's down from 334 this time last year. So that is very welcome news, and obviously is going to have a significant impact with respect to not only consumer sentiment, but spending ability heading into the Christmas season. Oil has really taken a downturn over these last few weeks, the China demand equation being one of the most significant factors. Obviously, the Biden administration's moves to tap the SPR earlier this year have also been a factor. But I have just been surprised at the acceleration in oil's downturn. And I have to confess, I was caught off guard by those gas price declines. And it's a welcome news to see it. First decline in a year.
You know, they do say the best cure for high prices is high prices. On the other side of that coin, though, on gas prices, given how the demand equation out of China has helped lower some of those figures, is there now a concern with China reopening that we may not be able to see Brent or WTI or any other measure keep at the level it has been? Is there a concern, in other words, for economists to say, kind of enjoy it while it lasts, folks, because the gas prices may not stay at a year-over-year low?
I think that is the concern, JD, but I've been mystified by oil price movements over the last few months, so I might be the worst person to ask, because I have been just confounded by it and have just found myself using. I'm finding it incredibly difficult. The China equation is significant, but OPEC has been in two minds for the large part with respect to its production cuts, but also talking about maintaining and maybe even talking about expanding. U.S. production is on the rise, and that's obviously good news, at least from the price perspective. There's an environmental impact that, well, there's a bill that's going to have to be paid at some stage, but no one really wants to talk about that just now. There are so many moving parts, the Russia price cap, whether or not Russia is going to cut its own output to mitigate that, what we are seeing with drilling and expansion here in the United States. And ultimately, Jay, what many people forget with regards to oil prices is how sensitive they are to movements in the US dollar. In other words, if oil is trading at 80 and the dollar is trading at 1, you are going to see them move in this direction. If nothing else changes and the dollar declines, oil prices are going to rise. And of course, the converse is true. So you have dollar sensitivity, the China demand question, US production, and Russia disquiet all sort of mingling together in a market in which the paper trading significantly outweighs the actual oil usage on any given day. You mix that all together and you have the volatility that we're seeing. And a big part of the reason why you could put your finger in the air and guess where oil prices are going to go and do just as well as me.
Yeah, I appreciate the point. Well, no, I could never do as well. None of us could do as good a job as you are, but I do understand that component, though, of being kind of mystified by it. But I'm glad you also mentioned what the strength or lack thereof in different cycles of the greenback does. Oil exporters prefer the U.S. dollar because it's the preeminent global currency here for a lot of these global investments. So people may not realize that, when we talk about the strength of the greenback or the U.S. dollar, that oftentimes you've got markets around the world that also like to reflect the strength of the dollar or trade in the dollar. And so I appreciate that part of the equation is top of mind as well. Also, by the way, for the political cudgel that this was against Democrats, high gas prices, obviously now we're after the election, so it's the sort of thing where, obviously Republicans running for re-election in the midterms were very inclined to use this to go after Biden. And now it's, probably just one talking point they don't have at their disposal. Obviously, there are others that I'm sure the GOP will be very quick to pivot to. Let me get your perspective here on Tesla. Shares were moving higher in the pre-market. I'll check the latest here in a moment. Banks are reportedly asking Elon Musk to use Tesla stock to back the loans he took out for his $44 billion purchase of Twitter. What else do we know? Help this make sense.
This is an interesting story, JD, as far as I'm concerned. I think that basically what Bloomberg has reported is that the banking collective is working with Musk in order to come up with different ways to sort of mitigate the cost structure of the debt that he was required to take on to purchase Twitter. He, of course, bought it for $44 billion. I think the overall cost was $46.5 billion, and around 13 of that was borrowed. Around 33.5 of it was part of an equity component, some of it linked to his sale of Tesla shares. But that $13 billion debt component, at least a portion of it, is trading at a very expensive rate. It's 11.75%. So it's that kind of high yield debt that's going to act as an overhang on Twitter's ability to be productive and to be profitable into the coming years. So the bankers are looking at ways to mitigate that, to, of course, maybe decrease some of their own risk. And I think, JD, more importantly, they are going to, force might be the wrong word, but they'd like to compel Mr. Musk to have more personal risk in this transaction than the banks, than bank risk. In other words, if the banks can swap this debt for a loan based on Tesla stock, suddenly Mr. Musk's decisions become far more important from a financial point of view to the banking group than is the case right now. It just puts more responsibility on him, and they would feel more comfortable as a result. Of course, the corollary is this will act as an overhang again on Tesla shares because they will be pledged on a margin basis to this banking group. And if Twitter moves in the wrong direction, it's going to have an impact on Tesla shares because he's going to have to pledge more of them to make up the margin difference. None of this has happened just yet. It's all at the reporting stage and no decisions have been taken. But once again, it illustrates two things: the complexity that Musk faces in trying to make Twitter profitable and the impact it's going to have on Tesla shares, which are down 50% so far this year.
They certainly are. They're down 1.7% right now, 57% year to date, 1 year, year over year, about 51 and change. Is this all indicative of a man who's bitten off a bit more than he can chew? overall? And also, at what point will we know? At what point will we know that that he's in territory where he's taken on too much more than he can handle? I mean, I feel like there's a grace period, right, to try and make the Twitter stuff work. Obviously, he's had a series of disastrous misfires so far, but I feel like are people going to give him a shot, give him a few months or so, 6 months, see where we're at?
6 months, I would guess, JD, would be the outside. It is going to be incredibly difficult, I think, for anybody, Mr. Musk or even the most seasoned media managers, to make Twitter the profitable enterprise that many people think it should be. We've often said that at the height of President Donald Trump's presidency, when his Twitter account was the de facto spokes platform for the White House, the US government, and the world's biggest economy, they still weren't able to make money. So in that respect, it makes it seem very difficult to understand what changes Musk is going to put in order to change that dynamic. It's just a business that trades on ridiculously thin margins. Whilst we give it a lot of potency and importance as a result of us being in media and following its machinations on a minute-by-minute basis, it's dwarfed with respect to its user base when compared to things like Snap, to things like TikTok, to things like Facebook and Instagram. It's an exceedingly important tool with respect to the dissemination of information, but it simply doesn't have the scale or the ability to generate profit in a way that is going to allow Musk to recoup the money that he spent. This will be a loss for him. And I think that's almost conclusive at this point. So your question, I think, is a good one. At what stage will investors sort of throw in the towel or just change their calibration as to what they can value Tesla at, given his intertwined activities with Twitter and indeed the other companies that he's involved with as well? A lot will depend, of course, on exactly what sort of growth he can drive for Tesla into next year. He's facing headwinds with respect to China demand, input cost increases. There's now talk of some difficulty in ramping up production in Berlin. So that portion of the story isn't getting any easier, and the Twitter situation seems to be only getting more difficult with each passing day.
I'm also reminded by a point you made, which is obviously this is the sort of story that we here in the media will breathlessly cover, understandably so, because we live on Twitter. We love Twitter. I was reminded during a conversation with my mother a couple weekends ago. She's like, what's the big deal? Like, what is the, you're right, it's just this sort of sense of like, for the millions of Americans who like don't care, aren't on it, live their lives off of these platforms, they're like, all right. So, and I was like, yeah, okay. I absolutely understand why someone looking at this from the outside would say, why does this matter? But you know, maybe the truth, of course, is somewhere in the middle. Perhaps we over-index on it because we live on Twitter, and maybe there's an impact for people as well. Okay, you want to do rapid fire, Martin? I think it's rapid fire time. Let's do it. Okay, time now for our rapid fire section, friends. Number one, how can GameStop end its 7-quarter slide? Ew.
If they have a plan to do it, they haven't told us so. They had a very brief call after their third quarter earnings last night. It only lasted a few minutes. They didn't take any questions. They talked about some of their achievements over the quarter and then said goodbye. But the fact is, they've lost money for a 7th consecutive 3-month period. I think the number was around 95 million. It was a 28 cents per share loss on an adjusted basis, and sales were down about 8.5%. They didn't have any significant fallout from the crypto winter, and that's good news because they had only inked a deal with FTX in September to sell some of their gift cards at GameStop stores. They said they don't really have any meaningful positions in cryptocurrencies, and they still have plans to develop that NFT marketplace. But it is a long road ahead. I think to Mike Furlong's credit, he basically said to investors, you're going to need to be patient. I thank you for your patience thus far, but we're turning around a company that was very near to bankruptcy into a sort of dynamic retailer with a structure that hasn't been seen before, and that's that hybrid brick and mortar and blockchain marketplace. He's going to need more time to do it. He may end up needing more capital to do it, but it was refreshing to see him illustrate those challenges. It would have been better had he taken questions, but maybe this is a case with baby steps for GameStop investors.
Fair enough. Number two, Costco earnings preview. What should we expect, Martin?
I'm really interested in this one. We're looking for a bottom line of $3.11 per share and probably something in the region of 54, 55 billion in terms of overall sales. So it's nothing to sniff at. It's an important company, and it's been an incredibly successful stock, really heading into the pandemic and definitely beyond. But its margins are starting to narrow as a result of the inflationary pressures, and spending is slowing as people look for more value and maybe pass by some of the more bulk items. So this has expressed at least some analysts' concern whether or not Costco is going to raise its membership fees. They range between $60 and $120 a year. It's a big revenue generator and ultimately a high margin revenue generator for Costco. But they haven't lifted membership prices in more than 5 years. And it's interesting now that they have said they don't have any near-term plans, but of course those could change reasonably quickly. We'll definitely be interested in that. I'll be interested in the margins and anything, JD, and it's always fun in this conference call that they have to say about the hot dog combo always gets attention. It's been stuck, that hot dog and soda combination, it's been stuck at $1.50 since 1985. The CFO told investors at the last conference call in September that he plans to keep it there forever.
Forever. I was really hoping that you were going to mention the $1.50 famous. We have to move on to the next one, but are you a fan of the food at Costco? I don't mean the stuff you buy in bulk. I mean the stuff you're buying hot, like the chicken bake, the $1.50 hot dog and soda, the churros.
I confess I have never had any of it, and I can't explain why. Every time I've looked at it longingly when I've come out of Costco with a basket full of stuff and I just haven't purchased it. Their fresh food and the pre-made food upstairs is fantastic, but I've never had the hot food, the pizza, the hot dog, and all those other things. They look fantastic. I've just not tried them.
I highly recommend the churros for the next time you're there. Okay, number 3 here. What a top breaking news story just within the last couple of hours. WNBA superstar Brittney Griner freed from that penal colony in Russia. How did the U.S. get her home, Martin?
It seems like a lot of negotiation, JD, and it appears that the United Arab Emirates were significant in brokering this prisoner exchange. Now, there's a dark side to this deal. I mean, it's first and foremost, I think we should express gratitude to the fact that Brittney Griner is coming back to the United States. She was arrested on the 17th of February for having allegedly cannabis oil in a vape cartridge in her luggage. She, of course, is one of the most accomplished basketball players in history and had developed a career there over a number of years, was traveling back and was arrested. She was sentenced to 9 years in a penal colony as a result of that, and many people understood that to be just a retaliation with respect to the U.S. defense of Ukraine and, of course, Russia's involvement in the invasion of that country earlier this year. So the UAE appears to have helped the United States in brokering an exchange which brings Brittney Griner back to the United States, but unfortunately releases a prisoner by the name of Victor Bout, who is essentially, JD, one of the most notorious arms dealers in history. And at the time of his arrest in 2011, I believe it was basically Interpol's most wanted man. So the cost for this, both in political and potential criminal terms, has been steep. So ultimately, that is the price that needed to be paid to bring Brittney Griner back, and just illustrates the complexity now of the U.S.-Russia relationship, which is probably at its nadir and levels that we haven't really seen since the late 1970s.
It's a deeply personal story. It's a geopolitical story. It's a judicial story. This is also at its core a story about pay equity with regards to why so many WNBA, even the biggest superstars of the game, can earn around at max the range of $225,000 here, but make well north or well into the 7-figure range if they go and play in leagues like Russia. That is the heart, because a lot of people had been going back and say, why was she even there? Why if you're the superstar? Yes, you could earn more in terms of marketing and endorsements and deals, but in terms of that base salary, pay equity is a big part of the reason that is under the underlying driver of this whole story that should not get lost. And I'm sure it'll be something the league will have to contend with moving forward. The great Martin Baccardax, thank you. Outstanding conversation, my friend. Have a great rest of your day.
Thanks, JD.
You got it, man. That's going to do it for the Market Open here from the floor of the NYSE. Stick with the street for more on these and all of the major market stories that matter to you. Have a great Thursday.